the fifth largest wheat exporter gets cut out of the market by the largest one, and wheat prices don't care? Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And we're going to figure out why that makes sense, because that's exactly what we saw happen this week, and wheat prices seem to shrug. There was a lot of hand-wringing about Russia exiting the Black Sea grain initiative being something that would cause a food crisis, would create instability all around the world. We've seen a preview of this kind of thing back during the Arab Spring protests, which of course were in large measure triggered by the last time that there was a serious disruption in wheat shipments from Eastern Europe, and in particular Russia and Ukraine. So why is it that wheat prices don't care here? Let's take a look. Let's figure out what's going on and how it fits within the broader market narrative and what it says about not just wheat, but other commodities, and especially those where Russia is a major exporter. And of course, that means crude oil, that means natural gas. So, first, a bit of stage setting here. This is what the numbers look like for exporting of wheat as of 2021. This is, of course, the year immediately prior to the war. And you can see Russia is by far the largest producer, 14.4% of the $61.8 billion market. Ukraine is the fifth largest at 9.5%. You'd think that a war between those two would create sufficiently difficult supply conditions that the price of wheat would go up, that there would be disruption, that there would be a surge. And if we look at how this has developed over time, there in fact was a surge, just only a very brief one. So you can see on the chart there where Russia invades Ukraine, there is subsequently a large spike in wheat prices. We shoot up north of $1,400 there on the benchmark ZW wheat future contract. We then quickly recede back, and we can see that there then begins a long and protracted decline that really starts to kick off once the initial spike settles into a bit of a range and the UN and Turkey begin to create some dialogue around maybe allowing more grain to come out of Ukrainian ports. Now, a bit of background there. Once the war begins, Ukraine mines the ports so that Russian vessels can't get close to coastal cities. Russia then blockades the ports from outside the mined perimeter. So nothing is going in and out. The only outlets then become by rail, which is not really scalable, nor anything that can really have the kind of capacity, even just in terms of where it needs to move through to get volume out. There is, of course, the disruption to farming, storage, and so forth itself, because there's a war going on the ground. And when these talks begin, they really start to focus on how do you get that harvest that Ukraine already has in silo out. And you can see that as we move through the year, Russia starts to play along. And right there in the first half of last year, we start to see Russia take some of the first steps to secure merchant shipping coming out of Ukraine. So Ukraine has to guide its ships through its own minefield. Obviously, it knows where the mines are since it put them there. And so you get that leg handled by Ukraine. Russia then ensures safe passage of those ships through its blockade, and there's inspections that are involved there. And then right around mid-year, a little bit later, you get the Black Sea Grain Initiative signed under the auspices of the UN and Turkey. The ships are inspected by all sides to make sure they're not being used for weapons transfers or anything like this. And since then, you can see wheat is in fairly precipitous decline. The change here, you can see in the red box, comes just this week when, after a second 60-day extension, Russia says, no, we're not going to extend it. But the pop in prices seems relatively contained. We certainly don't see anything like we saw at the beginning of last year. Now, a line chart can sometimes obfuscate spikes because it doesn't show daily highs. It only shows closes. But even looking at a candle chart like this, you can see we're pretty well capped under 750. This is not a price that's racing anywhere. Not in a hurry. Now, we did get a meaningful pop of about 8% and change. That sounds like it's big, but if we look at the daily range of changes, it's not really that far out of scope. So at the beginning of last year, you can see that's the initial invasion there. You can see some big spikes there. One spike north of 20% on a given day higher. Another spike north of 10% lower. We see that then we develop a kind of volatile range from give or take up or down 6%, 7%. So in that context, this most recent spike with the end of the Black Sea Grain Initiative right here of about 8.5, not really outside the range of the recent values. A little bit higher, but nothing like this, certainly. No signs of immediate consternation, no signs of a panic. And that, of course, raises questions. Well, how is that? Why? Why is it that the market doesn't seem to care? And what does that say? To try to get an answer, because arguably statistics out of both Russia and Ukraine in the middle of a war are not necessarily the most reliable, and that's perhaps not the fault of any stats agency in either country. They're in the middle of a war. And so instead, backing it out from the top importers seems like a good idea. And what I've done here is I've looked at the top 5. You can see Egypt, of course, at the top of the list. There is then also Indonesia, Nigeria, Turkey, China. And I've looked at IMF data tracking this. So not even country-specific data from their own stats agencies, because that can be hit or miss. But for consistency's sake, I've looked at IMF data, which is up to date as of a few months ago. So you can really get a sense for what the dynamics have been looking at the situation through a data set that really is based similarly and is of the same agency putting it together and is as consistent as it's going to get for shipping numbers out of a war zone. Data is up through February, so it should capture February of this year. So it should capture most of everything that we see during the operation of the grain initiative and how things have played out. Let's look at them in sequence here. Here's Egypt. You can see here that since the beginning of the war, shipments from Russia trending higher, shipments from Ukraine down and not really recovering. Now, here there is a bit of a competitive push and pull before the war starts. So you can see prior to the start of last year, there's a bit of a Russian edge because, of course, they're a much bigger producer, but Ukraine is actually fairly competitive in this market. There are quite a few months here where Ukraine is very close to Russian volumes or even exceeds them at times. But since the start of the war, the trends diverge in an unmistakable way. It's not quite as competitive in Nigeria. There seems to be a lot more of a preference for Russian shipments there. So maybe that's not surprising. But we can see that while shipments from Ukraine were certainly being had, since the start of the war, they've dwindled to nothing, by and large. In Indonesia, things were very competitive. There were quite a few months where Ukraine outstripped Russian supply. But since the start of the war, that's completely out of the picture. Shipments from Russia surge, shipments from Ukraine all but stop. In China, there was always a strong preference for shipments from Russia. We can see going back 5 years, it dwarfs shipments from Ukraine by a long mile. So too for Turkey. So why is it that global wheat prices didn't jump on the end of the Black Sea Grain Initiative? Well, because it doesn't seem like Ukraine has really been shipping enough to make a dent, because the war has really hobbled that's the situation so dramatically that you just were not making enough of a dent with that grain deal to really make a big market difference. This was still a situation where the war terribly hobbled Ukrainian output. There was a trickle coming out because of this grain deal. Shuttering it has not really changed the overall market landscape in a meaningful enough way. And really, these Indonesia numbers show that in spades, because here we have the two countries being the most competitive of any of the top 5 big wheat importers, leading wheat importers. And you can very clearly see that as the war starts, there is an unmistakable gap that opens. But that's not the whole story yet. There is also the larger story of Russian export commodity prices in general. And here it gets more interesting still. So what we have here in the light blue is the Bloomberg Commodity Price Index. This is an international benchmark for raw material prices, commodity prices, just in general, a kind of catch-all. You can see that since the beginning of 2022, commodity prices on the whole, year on year, I updated this today, so year on year as of today, going back to the beginning of last year, they're down 8.3%. And that's perhaps not surprising. We've had a significant slowdown in global commercial activity, of course, as central banks hike rates to cool inflation. We've seen many a time here on this very show the direction of commodity prices from about March of last year, and indeed cumulative global trade turnover from about March of last year, peaking just as the Fed begins its aggressive rate hike cycle. So, not surprising that commodities overall are down. Demand seems to be overall down, and that's a story well above anything happening specifically for Russia or Ukraine or the war. That seems to be generally what's going on thanks to central banks' aggressive tightening efforts. But what immediately jumps out here is that the top export commodities, especially those that have carve-outs and sanctions coming out of Russia, are down a lot more than the global commodity benchmark. So crude oil down 18, wheat down 17.5, nat gas down 74 and change. So these obviously are rather larger numbers than the 8% or so decline in raw materials in general. Not surprisingly, this raises some questions. Why is it that these things that are the top exporters for a country saddled with sanctions and in the middle of a war, which you would think would be disrupting shipments and which is cut out of global payments systems, which you would think would hobble their ability to do this, why is it that the prices are down and not up? Now, I, of course, don't have any bugs planted in the Kremlin, so take this with a grain of salt. But the sense seems to be, and looking at the USDA's WASDE report, there is some confirmation that this is occurring. What Russia is doing is very much looking at keeping its core commodity exports cheap as a fundamental element of its military strategy. Russia needs market share. It needs to retain the market share in these key commodities that it has, because it only has but so many ways to generate hard currency. Hard currency, of course, is currency that's not very volatile, that's likely to retain its value, that's unlikely to have a dramatic sudden collapse, which is what you need if you want to be able to, for one thing, finance a war. And Russia seems to be digging in for the long haul. So if, in fact, Russia is saying, we have to finance this war, we've been cut out from global markets in almost every way, but we have these carve-outs for these few things, we can't get outsold in these areas. So we need to keep these prices low. We need to undersell. We need to put as much product out there as we can, because this is the only way that we can generate the kind of income that we need to not get on the losing side of this war just for lack of financing. And so it would seem that at least part of the reason why wheat prices didn't go up outside of the fact that Ukraine hasn't really been able to use the grain initiative to send the kind of volumes that it's sent before hostilities, is that Russia is pointedly driving down the prices of those commodities that it sells most of, because it very much wants to remain the market player in those commodities, despite all of these difficulties that it has been. Now, why might Russia be focused on digging in and using a strategy like this to try to hold out through a longer period? It might well come down to just human numbers. So if we consider the wars in Russia's history that most immediately come up as wars where Russia feels itself most sort of historically represented, those things that are most in the Russian zeitgeist. When Russians think of these are the wars that define the country and its military experience, but chances are they don't bring up Afghanistan. Chances are they don't bring up the Russo-Japanese War. Chances are they don't bring up the various sparrings with Finland. The ones that really stand out, the formative military experiences, are World War II, Napoleon. And of course, the really, really formative experience, the Mongol invasion. But for the Mongol invasion, World War II and the fight against Napoleon really stand out in that both of them were essentially won by attrition. Russia lost tons of people in both of those wars and managed to outlast the enemy until the tide finally turned and the enemy was stuck in the very difficult Russian winter, and the Russian war effort was just able to outlast. This is something that's an overwhelming overlay, it seems to me, in Russian military thinking, and indeed in Russian social thinking. I have a bit of perspective on this, having been born there and spent a good part of my formative years there as a consequence. If we consider then the imbalance in manpower and the failed rush to Kiev at the start of this war, which surely the bigwigs at the Kremlin were hoping would have been successful, would have been as successful as the land grabs in 2014, where they essentially grabbed Crimea unopposed. They grabbed a big piece of eastern Ukraine without too much resistance. It then, of course, turned into a significant skirmishing situation for the next 7 to 8 years that then metastasized into what we're seeing now. Having seen that initial rush fail, the numbers start to kick in, and thinking of past experiences, especially those formative experiences, the Napoleon experience, the World War II experience, those things start to come into play. And the idea of a war of attrition starts to really crystallize as something that perhaps Russia thinks, well, here's a thing we do well. Here's a thing where we've been successful. Perhaps this is how we fight this as well. And if you consider the mismatch in overall available manpower, in fit for service manpower, in the number of people reaching military age annually, in the number of currently active military personnel, Russia has way more people on every count. And so if the war had to become a long, drawn-out attrition type of exercise, Russia has an advantage. And what do you need to finance such a thing? Well, you need a steady flow of hard currency to survive through that. It's one thing to have enough people, but if you run out of money, well, then that advantage disappears on you. And so a natural extension of thinking about the war in Ukraine now as less of a rush to quickly get something done and more of an attrition war that's going to take a long time, a natural extension is, well, you need income to do that. And perhaps the economic overlay here is to keep commodities that Russia sells cheap, to underprice them purposefully on global markets to retain as much market share as possible, as we see here, to enable this advantage to be one, which suggests that maybe the end of this grain initiative and the tepid response from wheat prices actually makes sense, but also that we may not very soon get off the ground on natural gas, may not soon get off the ground on crude oil for the very same reasons. And that is macro money for today. Thank you very much for joining me. I am hopefully going to be back in full next week. We had a bit of a abridged macro money week this week. I hope you guys enjoyed the replays of some choice shows that we've had for you all week. The plan is to be back with all original content next week, once again, as per the usual, Monday through Thursday, right after Overtime, a show I do with Head of Futures and Forex, Chris Vecchio, where we take a look at the day's events and try to make sense of them. I'll be on with Chris tomorrow for Futures Power Hour, on with Tom and Tony for First Call on Sunday, as per the usual, writing for the News and Insights section of tastylive.com, and opining on Twitter at Ilias Pivak. Good luck trading out there, everybody. See you soon. Take care.